All right, welcome to 20-minute Annuity Tuesdays. I am Trent Zimmermann, Director of Annuities here at BJ Insurance. BJ Insurance is a GA working with independent agents and insurance licensed professionals on life insurance, annuities, long-term care, and disability. Uh, I have a bachelor's with a focus on economics, a master's in finance. I am a chartered financial consultant and chartered life underwriter. And here is your 20 minutes. We're talking about annuity ladders. I told you guys last week that if you did not vote for annuity ladders, I was going to do it anyways. You guys did vote for it though, so that made it easy for me. This is something that I've talked about a lot, um, but we haven't done it yet. And I think it's something important to go through because what we're going to talk about is a strategy that I want you to walk away with that will decrease the amount of risk your clients are exposed to, increase their liquidity, and then also increase your sales pipeline. So let's get started here. Just as a refresher, we're going to be talking about two different types of annuities today, fixed index annuity and fixed annuities. We're not going to be talking about income. We are actually going to be talking about that next week. And I'm actually a little housekeeping before we get started that I almost forgot. Um, we have this all set up on Zoom. They only allow a maximum amount of time to schedule these out for. This is our last week of doing it. So there's going to be a new registration cycle going out this week. So make sure you re-register even though you already are registered. Sorry, next week. Next week, we're going to be talking about income laddering, and the week after that, we're going to be talking about private equity and annuities because those are important topics, and we're not going to be able to complete the annuity ladder this week. And the private equity, I need to do an interview with a industry expert, and then finish another book. That one's going to be a well-researched and well-cited one. Anyways, back to the types of annuities we're talking about this week. Fixed index is a annuity that has principal protection. You can't lose money in these annuities, but you have no guaranteed growth unless you're in the fixed account. The growth is going to be tied to stock market index. A fixed annuity is often referred to as a CD type annuity. I'm going to be referring to them as multi-year guarantee annuities or MYGAs. And these are annuities that for a set term will guarantee a return for you. Now, multi-year guarantee annuities or MYGAs, again, CD alternatives, when CD rates right now are sitting between 4 and 4.2%, MYGA rates are at 5 to 5.6. And that 4 to 4.2% is the jumbo long-term CDs. Your average rate that most people are experiencing is probably closer to 3.9. There are some simple interest MYGAs that are getting up to 6.5. So just be aware of that because we will circle back on those. Fixed index annuities or FIAs or FIAs. Historical performance, if you've been on these before, you've seen this slide, is 6.88. That's from LIMRA. And that includes the entire market of annuities. And if you've seen me talk about annuities, if you've sold an annuity yourself, you know there are good and bad annuities. There are good and bad companies, some that will honor their cap and par rate and do a pretty good job of keeping it consistent through the life of the policy, and others that will kneecap you and cut those cap and par rates into the surrender period. And there's also volatility controlled indexes that we talked about at the start that have averaged below 2%. And then there's equity based that have hit their cap and par when the markets do well. Uh, so S&P historical performance 10.44. People will say that these can outcompete the market. I'm not ever going to promise you that. In the right sequence, it can, but we're not going to promise that here. What we can say is historically, these have done better than the safe money alternatives of treasury bills and bonds. As you can see there, the historical performance of those, the highest has been 6.3. The world of fixed index annuities on average has done 6.88. Now, bonds and treasuries don't come without risk. In the last 26 years now, we've seen three bear markets and pricing crashes where they have dipped by the lowest was 49%. So these bonds and treasuries aren't without risk, even though there's a safe money alternative, which leads a lot of people to say annuities are risk-free assets. And that's true in a certain respect because we did talk about the principal protection. Some of these can have guaranteed growth. And as we just showed, they outperform their comparable assets, MYGAs to CDs, FIAs to bonds and treasuries. But why that's false is because you're going to have that renewal rate risk. When the MYGA or the multi-year guaranteed annuity is out of surrender, we don't know what the market rate is going to be at that point. You might be rolling over into 2% guaranteed, or the rates might be higher at that point. But you also have that inside of a policy with a fixed index. Is it going to stay at a 9% cap on the S&P 500 for the length of its policy? Then you have inflationary risk. This one isn't a large risk, but it is something to talk about, especially if we go into a decreasing interest rate environment where MYGAs are at about 2%. I don't think we're going to have a sustained inflationary environment over 5 years of north of 5%. If we did, we'd have a lot to worry about and probably good to have some money in safe alternatives here anyways. Liquidity risks. The average annuity that we're going to be talking about is going to have a 10% free withdrawal, but that still leaves a lot of money locked up. That's why these products perform so well, is because the money's locked up, but that creates risk for your clients if they have an emergency where they need to pull money out of their safe money. And then the opportunity cost. This is kind of like inflationary risk where we don't see it as a big risk, but we see it a lot with high net worth individuals and young individuals that say the young individuals can ride out the market and the high net worth individuals who don't need this money will still survive retirement. If they lose it all, can say, I can get a higher return elsewhere. That's true. But in the market that we're looking at, approaching retirement or in retirement, they're living in this space, to quote Warren Buffett, of why risk what you have for something you don't need. And so opportunity cost isn't something we're going to be approaching a lot. But the strategy today is we're going to be looking at renewal rate risk and liquidity risk and how to reduce the renewal rate risk and create more liquidity in the portfolio. So a lot of people, when they talk to me about annuities, are thinking that it's going to be attached to the Fed fund rate. And while it does, it is married to the Fed fund rate in a certain sense. It more closely tracks the 5 and 10 year Treasury yields. So I want to put this graph up here to show that those aren't exactly attached to the Fed fund rate, and there is still a lot of volatility in it, but the swings are not going to be as big as the Fed fund. But that still means you're going to have a percentage point delta in the MYGA rates a company will offer within a year. And they're usually going to change every month. And so we're going to borrow a strategy from the bond traders that they've been doing for hundreds of years, building a ladder. And as I said at the start, our goals with this are going to be to reduce the renewal rate risk, increase liquidity, and increase your sales pipeline. And I'm actually going to exit out of this, and we're going to look at um, some spreadsheets here. Let me and go through the different ways we can do these ladders. So the first is going to be the easiest, and that's your systematic portfolio de-risking. This is somebody who says, I want to take tranches out of my portfolio a year at a time and de-risk them. This works really well for people who have a tranche style retirement plan where they know the amount of money they need for each section of their retirement, and they're trying to take money out of the market risk so they don't have a bad sequence of return and put it into a safe asset and be able to have that carry them until that timeline. And so every year you're going to be pulling out an annuity and placing it in here so that it reaches maturity when you need it. We're using MYGAs in this case, and I'm not having the rates change for complexity here, but we're doing a consistent 5 year because that's where the best bands are. Now, You can do this with the standard compounding, but I also want to show you how this looks with a simple interest product. And these simple interest products can be really good for people who are approaching retirement, who are saying, uh, I don't know, I don't want to pull money out of the market if it's down. I'm going to have differing opinions of how the market's going to do from year to year. And so I'm going to put them into a simple interest product. And what you can do here is with $10,000 being the minimum you can contribute to starting a MYGA, you put in enough year one so that the simple interest it kicks out is over $10,000. And that 10,000, because it's not working for you, it's not being compounded, and you can pull it out without having any effect on your end earnings. You can start a new annuity with that money in the next year. And you're already going to be doing it. That gives you an opportunity to talk to your client and say, do you have any more money you want to add to this? Yes or no. And you continue to do this until that first policy is out of surrender, in this case, 7 years. And now you have yearly tranches that you've built out that they may or may not have added to that can get them to this safe money tranching that every year you're going to have a pipeline going through of policies to sell that they can either add money to or fully liquidate. And so this is really a more flexible version of what we see here. And what we see here with the standard compound interest is going to be good for somebody approaching retirement or in early retirement, whereas the simple interest is usually entering into retirement. So now let's say you have Mrs. McGillicuddy and she has $500,000. She didn't do this systematic de-risking, but she just says, I need to get this money safe. This is more often what we see. And let's say she wants to get that money out in 10 years. And 10 years worries you because she might have an emergency in the meantime. So you might not want to grab that 10-year band. You might want to grab where the money's best at 5 years right now. And so what we typically see people do is either they buy that 10-year or they buy a 5-year, and now they don't know where uh, that interest rate will be when that 5 years up. Sometimes we will have people stack and try and build a ladder, and it looks something like this. This isn't the ideal way to do it. It's the easiest way to do it that you know you're getting a 10 that won't roll over. You'll get a 7 that rolls over to a 3, a 5 that rolls over to a 5, and a 3 to a 3. And you just keep those going. That leaves 1 year where I put in the CD rate that you just carry it for a year. And if rates stay the same, you'll do slightly better than the 10-year. If you leave that money, um, if you don't do anything with that money, it will do worse than the 10-year. So what I recommend instead is doing this laddering structure. And bear in mind, I'm doing 10-year for illustrative purposes. I don't typically see people do 10-year annuities. That's a long time to lock up money. I won't recommend it, but we're doing this for illustrative purposes here. That we are doing a 7-year that rolls over to a 3 to a 7, and we're continuing this 5 on. And that maximizes the amount of time in this 4-year period here that you're getting the highest average rate. And now you're going to outperform the 10-year. You're going to outperform the stacking and have a little bit less risk. And you're going to have annuities come up every 2 to 3 years they have to sell. But that's if Mrs. McGillicuddy has an end date in mind. If she doesn't have an end date in mind and she just is trying to get this money to be her safe money chunk of her portfolio for an indefinite amount of time, she doesn't need it for retirement. This is her backstop. We can create an indefinite annual tranche with that initial money. So same thing here. Again, I don't typically see the 10-year being used. I'm doing it for illustrative purposes here. But you get a 10, a 7, a 5, and a 3. And our goal is to maximize the highest return band, which is 5-year. So we roll that 3 into a 5, 5 into a 5, 7 into a 5. But you'll notice here, and the reason I did the 10 is because it will lead to coinciding dates on the 5 and the 10. And that's what we don't want. Because if we have two annuities coming up at once, uh, that means we have a large liquidity event, which also means we have a large portion of time that we're illiquid in them. And so if we offset by putting a 3 year here and later a 3 year here, we get to a point in year 15 where every year some policy is coming up and they have a liquidity event that they can pull out. Now, instead of that 10%, if this is all equally distributed, 25% in their portfolio plus the 10% in the others, to have a larger liquidity pool available every single year. And now you're also speaking with that client on a year-to-year basis. You're having consistent sales coming from that. Now, like I said, this isn't typical that you would do a 10-year, but it shows that we don't want to have coinciding annuities in this case, and so we want to offset them. Now, the simple interest, we can do that same strategy we talked about before. Let's say we spread out and we have somebody who's uncertain if they're going to put money in the next year. You can have this simple interest seeding to create annuities uh, every single year that the client can add more or less money to as they go along. So when these come due, they can say, we're going to add more money to that tranche or not. But now, in that 7 year period, you've built yearly policies coming into surrender for the life of their retirement that you can renew into new contracts and reduce their renewal rate risk, increase your own sales, and increase their liquidity events. So we're going to exit this again. I'm going to go back to the presentation. Um, because all we've talked about right now is MYGAs, right? Well, can we do this with FIAs and should we do this with FIAs? And to that, my answer is absolutely. Because when we're looking at an FIA, we're looking at the pool of money that you put in. And a chunk of that money is going to be buying fixed income assets. And the income that those are going to shoot off is going to create a small sliver of the profit for the carrier, and the rest is going to create the option budget. And you get the entire options of the good how high they perform and how little. Now there's going to be some back end math of if we're using 60% of this portfolio to be in the options budget, how much does it mean for the cap and par rate? But that means a large amount of the cap and par rate is determined by the bonds they buy year one when you buy that policy. And then it goes for yearly volatility as well, and the time value each year when they're buying those options. But the amount of money that you have is going to be determined to year one, with exception to some private debt that these carriers can be holding. So although there is some inside the policy renewal rate risk, you're still experiencing that surrender period renewal rate risk. And so it's good to do with the fixed index annuities, these tranches as well. Now I'm going to add, I've only shown and described doing this with one style of annuity. What we more often are talking about is blending these, getting a 3 and a 5 year MYGA and getting a 7 and a 10 year fixed index so you have some more upside potential and you're building a guaranteed floor with the MYGAs. And you can still get to that indefinite tranching as you go, and you can even de-risk those FIAs into MYGAs as you go. But when we're starting out, we are talking about blending these. Now, again, next week we're going to be talking about using this for income. Right now, we're just talking about the accumulation phase or creating a safe money bridge. But if you have any questions, please feel free to ask. I hope this was understandable. I know I was going through a lot of charts there. Please feel free to reach out. And as a reminder, next week we're going to be talking about the income story along with this. And the week after that, we're going to be talking about private equity. And make sure you check your emails and re-register because we're at the end of the period of time that we can book these out with Zoom and we have to start a new cycle all over again. So make sure you re-register if you're getting value out of these. Feel free to call or email if you have any questions about this ladder strategy. And that is your 20 minutes. And I'll see you next week with income laddering.